If you own gold and you watched it fall during a war, I want you to understand something before you make your next move. When an asset that is supposed to be insurance starts dropping while missiles are flying and oil routes are being threatened, the average investor reaches for the wrong explanation. He says gold failed. He says the safe haven story was a lie. He says the market is irrational, and then, because he thinks the story broke, he breaks his own discipline right along with it. I have spent a lifetime watching markets punish people who confuse price with mechanism. What matters most in moments like this is not the headline. It is not the chart on your phone. It is not even the war by itself. What matters is the chain reaction that the war sets off inside the monetary system. Once you understand that chain, gold falling during a war stops looking mysterious. It starts looking almost inevitable. I have always believed that if you cannot explain a market move in plain English, you do not understand it well enough to put serious money behind it. So let me explain this the way I would explain it. If you were sitting across from me and you had just watched one brutal week wipe out more paper wealth than you thought possible, the first thing you need to see is that gold is not traded in one market. It is traded in two worlds at the same time. There is the world of real metal where central banks, long-term savers, and patient buyers think in years. In that world, gold is reserve insurance. It is collateral without a promise attached to it. It is an asset that does not depend on a banker, a politician, or a payment network behaving properly. Then there is the world of paper gold, where futures contracts, leveraged funds, algorithmic systems, and short-term traders think in minutes. In that world, gold is a line on a screen, a trade expression, a momentum object, a vehicle for leverage, a way to borrow excitement from tomorrow and spend it today. Most of the time, those two worlds move together closely enough that ordinary investors think they are the same thing. They are not the same thing. And whenever the monetary system goes under stress, the gap between those worlds becomes the whole story. That is what I believe you are watching now. A war breaks out in the Middle East. Tanker routes are disrupted. Oil does not simply become a little more expensive. Oil becomes a monetary shock. The average person hears that and thinks about gasoline. The serious investor hears that and thinks about every price in the economy that takes its orders from energy. Fuel rises, transport rises, food rises, fertilizer rises, industrial inputs rise. The inflation problem, which everyone wanted to believe was dying quietly in the corner, comes back into the room and sits down at the head of the table. Now follow the chain, honestly. If oil is surging, inflation expectations stop cooling. If inflation expectations stop cooling, central banks cannot talk the way they were talking a few months earlier. If central banks cannot cut rates the way the market hoped, bond yields stay higher. If bond yields stay higher, the dollar becomes more attractive. And if the dollar becomes more attractive, at the same time a war is making investors desperate for liquidity, the machines begin to do what machines do. They stop caring about stories and start obeying rules. I call that the dollar magnet. When the dollar magnet turns on, it pulls capital toward yield, toward liquidity, toward the cleanest short-term expression of safety available inside the existing system. And gold, especially paper gold, suddenly stops being treated like insurance and starts being treated like an asset with no yield competing against an asset that now does pay. That is the first mistake most people make in real time. They think war should mechanically equal higher gold. War is a sequence. If the war first creates an oil shock, and the oil shock first strengthens the inflation scare, and the inflation scare first delays rate cuts, and delayed rate cuts first strengthen the dollar, then gold can absolutely be hit before it is helped. That does not mean gold lost its purpose. It means you are watching the wrong phase of the sequence. Now let me show you the second force, because this is where real damage gets done. I call it the paper avalanche. When regular investors get excited about a rising market, they rarely buy the calm version. They buy the loud version. They do not just want gold. They want 2 times gold, 3 times gold, daily magnified gold. They want the thrill of being right faster than reality. That works beautifully while prices are rising. It is poison when prices turn. A leveraged product has a design feature hidden behind the sales pitch. It must rebalance. It must adjust. It must respond to daily price movement, not long-term logic. So when gold falls, those structures are forced to sell into weakness. That selling pushes the price lower. The lower price triggers more stress. More stress triggers more selling. What looked like enthusiasm on the way up becomes a wrecking ball on the way down. That is not morality. It is mechanics. Most investors think leverage only changes the speed of profit. It changes the structure of survival. I have watched this movie in different costumes for decades. The names change, the brokerage apps get prettier, the language becomes more modern, but the core mistake is ancient. People borrow emotional certainty from a trend, then discover that borrowed certainty gets margin called much faster than real conviction, and when that avalanche starts, it does not wait for you to finish your sentence. I want you to notice something important here. The investor who owns unleveraged metal or a plain structure tied to metal may feel pain, but he is still in the game. The investor who owns magnified daily exposure is often no longer making a decision at all. The product is making the decision for him. That difference matters more than almost any chart pattern you will ever study. Now we move to the third force, and this one is the most misunderstood of all. I call it the sovereign pawn shop. Most people assume central banks buy gold for one reason only, because they are bullish. That is much too shallow. A central bank buys gold because it wants reserve assets that sit outside another country's political control. It buys gold because paper promises can be frozen, sanctioned, diluted, or weaponized. Gold cannot be printed, and it cannot be canceled with a keystroke. That is why official buyers spent years accumulating. But a reserve asset is still an asset. And under stress, assets become collateral. Here is the uncomfortable truth. A nation can believe in gold deeply and still be forced to sell it. Not because the long-term case changed, because its short-term survival changed. If a country imports most of its energy and oil suddenly surges, that country needs dollars. Now, if a country pegs or heavily manages its currency against the dollar, that country needs dollar reserves now. If capital is trying to leave, if food and machinery imports still need to be paid for, if political stability depends on the currency not breaking, that country needs liquidity now. Not next quarter, not after a committee meeting now. And when now arrives, gold reserves stop being philosophy and start being collateral. That is why I say some investors misunderstand what they are seeing. They think selling by an official holder means the strategic story died. Often it means the opposite. It means the official holder values gold enough to have stacked it precisely for a rainy day, and the storm has arrived. You see a sale and imagine betrayal. I see a sale and ask what emergency required collateral. That is a very different way of looking at the same data. Years ago, I learned to ask one question before reacting to any violent move in a supposedly safe asset. Is this strategic selling, or is this forced selling? Strategic selling tells you the worldview changed. Forced selling tells you the cash need changed. That distinction is everything. When governments that built gold war chests start liquidating because their currency systems are under pressure and their dollar inflows are impaired, you are not watching a thoughtful vote against gold. You are watching the sovereign version of a margin call. A retail trader gets a call from a broker. A stressed nation gets a call from math. The language is different. The mechanism is the same. That is why the historical parallel matters. Markets have seen episodes before where oil states or heavily constrained official actors sold gold, not because they stopped respecting it, but because they needed funding, currency defense, or budget support faster than they could get it any other way. Once you understand, a violent drop in gold during a war no longer feels like a contradiction. It feels like collateral being thrown overboard to keep the ship afloat. Now let me show you the fourth force. I call it the paper to vault split. This is where patient people can lose their minds if they are not careful, because the screen tells one story while the physical flow tells another. On the paper side, you can have futures dumping, leveraged funds, rebalancing, algorithms selling, and trend followers piling on after key technical levels break. On the physical side, you can simultaneously have metal leaving vaults, long-term buyers stepping in, Eastern demand, strengthening, and the people who actually want possession treating the decline like a sale rather than a signal to surrender. In other words, the paper market can crash while the physical market quietly votes confidence. The average investor never sees this because he thinks the quoted price is the whole market. It is not the whole market. It is the most visible market. Visibility and importance are not the same thing. A voting machine is loud. A weighing machine is patient. That has always been true in stocks. It is true in metals. It is true in almost everything that trades. So when you tell me gold is crashing, my first instinct is not to argue with the price. My first instinct is to ask who is selling, under what pressure, in what form, and who is taking delivery on the other side. That is how you separate noise from transfer. Because a lot of what looks like destruction in markets is really transfer. Metal is transferred from the leveraged to the liquid, from the impatient to the patient, from the person who needed the thesis to work by Friday to the person who prepared to wait 5 years. If you do not understand that transfer, every correction feels like a verdict on the whole story. If you do understand it, you stop asking the childish question, is gold dead, and start asking the adult question, who is being forced out and who is stepping in. Now, I want to speak plainly about the psychological trap because this is where most people actually lose their money. They say they are long-term investors. But what they really mean is that they are willing to hold as long as the asset rewards them quickly enough to preserve their confidence. That is not long-term investing. That is delayed panic. A man buys gold because he says the monetary system is unstable, governments are over-indebted, currencies are fragile, and geopolitical risk is rising. Then gold drops sharply because the monetary system becomes unstable. Governments need dollars, currencies come under pressure, and geopolitical risk rises. He sells. What happened there? The thesis did not fail. His emotional plumbing failed. He wanted insurance that reassured him every day. He did not want insurance that would sometimes look stupid before looking necessary. That confusion ruins people. I have no interest in mocking it because it is common, but I do want to expose it. If you own a reserve asset, you must expect reserve. Asset behavior under stress, not fantasy behavior under headlines. You must expect volatility. You must expect the paper market to overshoot. You must expect moments when the thing you bought for protection gets marked down by people who are being forced to choose cash over principle. That is not a reason to be reckless. It is a reason to be structured. Now let me give you the identity shift that matters here, because most investors need it more than they need another forecast. You do not want to think like a tourist in the metals market. A tourist buys after a huge run because excitement is contagious. A tourist borrows exposure because speed feels intelligent in a bull move. A tourist measures success by whether the screen confirms his ego every day. A tourist sees a violent drop and concludes the whole trip was a mistake. You want to think like an insurer. An insurer assumes stress will come. An insurer assumes there will be moments when claims surge, prices gap, and weaker hands have to liquidate. An insurer prepares cash flow, position size, and time horizon before the storm. An insurer does not demand that every hedge perform instantly on every headline. He asks whether the structure still serves its purpose through a full cycle. That identity shift changes everything. Worker money chases performance. Owner money studies mechanism. Tourist money needs applause. Insurer money needs survivability. The more serious your capital becomes, the less dramatic your behavior should be. That is one lesson age teaches if you are willing to pay attention. Now, let me bring this down from theory and into a practical operating system, because I do not like high-altitude speeches that leave you with nothing but atmosphere. When an asset tied to monetary disorder is falling during a period of obvious disorder, I use a 3-part protocol. First, I separate the reason I own it from the reason it is moving. That sounds simple, but most people never do it. If I own gold because I believe debt, deficit finance, currency management, and geopolitical fragmentation create a long-term bid for reserve assets outside the paper system, then a short-term move caused by higher yields, stronger dollar pressure, forced sovereign sales, and leveraged paper liquidation is not automatically a thesis violation. It may be painful, it may even get more painful, but pain and invalidation are not synonyms. Second, I examine the balance sheet of my own life before I examine the chart. Do I own this with leverage? Do I need this money soon? Am I so concentrated that I am one bad month away from emotional stupidity? Do I have cash flow that lets me accumulate if the reset deepens? Do I actually have the temperament for a slow asset that can move violently in the wrong direction before the long-term thesis is recognized again? A lot of people skip these questions because they are less exciting than a target price. They should not skip them. Most investment mistakes are life. Structure mistakes, wearing market costumes. Third, I define in advance what tells me the pressure is worsening and what tells me the pressure is easing. If the dollar stays too strong for too long, that matters. If yields stay too high for too long, that matters. If oil remains violently elevated and keeps pressuring importers and dollar pegs, that matters. If forced sellers keep showing up, that matters. On the other hand, if the dollar loses altitude, if yields break lower, if energy stress cools, if physical demand keeps absorbing paper weakness, then the conditions for a very sharp reversal improve. I do not need certainty. I need a map. Markets never pay you for certainty. By the time certainty arrives, the easy move is already behind you. That brings me to another point most people hate hearing. A reset does not have to be brief to be bullish later. The market owes you nothing in terms of pace. Gold can have a brutal week, then a brutal month, then a dull period that feels like punishment for anyone who wanted immediate validation. None of that, by itself, destroys the larger logic. It may simply mean the transfer is still underway. I want to say something else that men in particular often need to hear. The urge to prove toughness by using leverage in a volatile insurance. Like asset is one of the most expensive forms of insecurity I know. It masquerades as courage. It is usually ego financed by borrowed fragility. Real strength is not magnification. Real strength is staying power. The man who can hold a sensible position through a reset without needing to boast, panic, average recklessly, or surrender his plan is already operating at a level most people never reach. He understands that capital is not built by dramatic declarations. It is built by surviving enough cycles to let asymmetry work in his favor. Now, does that mean every gold decline is a gift? No, I am not interested in lazy slogans. Sometimes an asset is simply overpriced and needs to come in. Sometimes enthusiasm runs ahead of structure. Sometimes a huge advance creates exactly the kind of crowded, leveraged ownership that guarantees a cleansing. That can be true at the same time the long-term case remains intact. One of the habits that helped me most in markets was learning to live with layered truths. An asset can be strategically attractive and tactically vulnerable. A thesis can be correct and early. A panic can be justified for the leveraged and useful for the liquid. A war can strengthen the long-term case for a reserve asset while weakening its paper price in the near term through the dollar and rates channel. Layered truths do not bother me. They bother investors who need a cartoon instead of a framework. If you want a cartoon, every market looks confusing. If you want a framework, confusion starts to clear. Let me also address the temptation to worship the price history that suits your argument. People love to say gold eventually recovered from this or that, therefore relax. Other people love to say a bad historical episode lasted years, therefore despair. Neither response is mature enough. History is not there to give you emotional comfort. It is there to teach you mechanism. If you study a prior period and all you take away is a target or a timetable, you learned almost nothing. If you study a prior period and learn how oil currency defense, sovereign collateral, rate pressure, leverage, and physical demand interacted, then you have something useful. That is what I care about. Mechanism travels better than prediction. Now, where does all this leave the ordinary investor who has some exposure to precious metals and feels like the ground moved under him? It leaves him with a choice. He can keep pretending gold is supposed to rise on cue every time the world gets uglier, and therefore every decline is proof of failure. Or he can grow up as an investor. He can accept that there are phases when the first thing a crisis does is create a dollar shortage, a yield problem, a leverage flush, and collateral sales. He can accept that paper markets are violent, that official holders can become forced sellers without abandoning the strategic case, and that the most important thing in a reset is not being right loudly but being positioned sanely. That is the contract. If you insist on speed, you will probably be served volatility. If you insist on leverage, you will probably be served liquidation. If you insist on daily emotional reassurance, you will probably sell your insurance right before you need it. But if you build your exposure with cash, patience, diversification, and a genuine time horizon, a reset can stop feeling like a verdict and start feeling like a transfer. That is how I see it. I do not know whether the next move is up next week, next month, or later. I have never confused discipline with pretending to know the exact date of a reversal. What I do know is that the monetary system is not becoming simpler. Debt is not becoming smaller. Reserve politics are not becoming more trusting. And the desire for assets outside someone else's promised structure is not disappearing. That long arc is why gold matters. The short arc is why people lose money in it. You have to understand both. If you only understand the long arc, you will underestimate pain. If you only understand the short arc, you will sell the larger opportunity to escape the smaller discomfort. The best investors learn to hold both in their mind at once. So here is the final test I would leave you with. When the paper market is screaming that gold is broken, and the physical market is quietly absorbing supply, and stressed sellers are throwing collateral into the street because they need dollars, and the crowd is demanding a simple answer to a layered event, what are you going to be? Are you going to be the man who confuses volatility with failure, borrows conviction from leverage, and lets price tell him what to believe? Or are you going to be the man who understands the mechanism, sizes the position to his life, keeps his options, and uses resets to move from tourist money to insurer money? That choice matters more than this week's candle. Because the real question is not whether gold had its ugliest week in a generation. The real question is whether you are building a financial life that can survive ugly weeks without forcing you into ugly decisions. That is where wealth actually begins. And that is where most people, sadly, never even start.